very good evening to everyone. I hope you all are fine and doing well. So I am Aishwarya Sharma with the chapter number 5, that is facilities for the exporters and the importers. If there is a wide concept that is of international banking, so there are also some facilities which are available for the exporters and when as well as for the importers. So we are going to discuss this today, and before starting the class I just want to make sure that I am audible, visible, and my screen is visible to everyone. So as the winters are started and winters are there on peak, uh, so let's start to know about the what are the facilities that are available for the importers and the exporters. Okay, just a minute. Okay, so let's discuss today first about the DGFT, a very important, that is DGFT, Directorate General of Foreign Trade. DGFT, that is comes under Ministry of Commerce and Industry. Basically this is a type of a agency of the government of India that basically do what, like a we can say that plays a central role in the formulation and also in the implementation of the India's foreign trade policies. Okay, it functions under the Ministry of Commerce, and its primary objective is what, is to regulate and promote the exports and imports in the country. That is the basically we can say that is the basically primary objective, is to regulate and promote the exports and imports in the country. Fine. And in India you can see here export trade is managed by the DGFT, which is a part of Ministry of Commerce and the Industry. This DGFT announces the rules and the procedures, what will be the rules for the exporting goods. And here the financing of trade and foreign exchange regulations that are controlled by the RBI, and this is according to the FEMA. Import trade is also regulated by the DGFT, while the RBI oversees the foreign exchange rules for the imports as per the FEMA guidelines. And if we talk about what will be the responsibilities of the DGFT and the functions of the DGFT, basically it formulates and implements the foreign trade policies, and there we can say the export promotion and also the regulation trade facilitation. There is also the issuance of the import and export, issuance of the export and the import. Both import and exports, these are governed by the exchange control and trade control regulations. They basically manage special schemes, DGFT. They monitor everything, they enforce everything, they promote some type of ease of doing business trade data. They collect the data and analyze the capacity building and the awareness. So the RBI under the FEMA 1999 manages the foreign exchange rules, like how to do payment, how to do receipt of foreign exchange that are handled. And this DGFT on the other hand oversees the country's international trade. How? By implementing the FTP and issuing the announcements to promote or control the exports and imports. That is the basically work of the DGFT. Now clear? DGFT works under Ministry of Commerce. Fine. Okay. Moving to the next one slide. RBI sets all the guidelines how to do exports and how to offer the credit to the exporters at the international interest rates so they can compete globally. And this FTP includes all the rules for importing goods to protect the country's foreign exchange reserves while encouraging the technological improvements and a competitive environment. That is basically what is the work of RBI and also the work of FTB. Fine. Now you can see here, Ministry of Finance includes which departments, and Ministry of Commerce you can see includes which department. Ministry of Electronics and IT is included these departments. We will discuss all about these things: authorized dealer category, banks, what are the meaning of full-fledged money charges, software technology parks in India. We will cover these in for the upcoming slides. Now let's talk about the IEC number. What is the meaning of IEC? See, IEC basically we can say is a type of unique 10-digit code. This is a unique 10-digit code which is issued by the DGFT. And this is mandatory for those who are wishing to engage in import or export trading activity in the India. So anybody who is involved in export or import trade in India must apply for or obtain an IEC number from the Directorate General of Foreign Trade. And this applies to those individuals, firms and the companies. So that is the meaning of IEC, Importer Exporter Code Number. Clear? Now, moving to the next one. If is there someone who is exporting the services, they get our registration cum membership certificate from the Services Export Promotion Council or the Federation of Indian Exporters Organization. And why we can say this IEC number is a unique 10-digit code issued by the DGFT, okay, which is required for the some activities. We can say this is mandatory for conducting the international trade. This is mandatory for the one-time registration and no renewal. There is one-time registration, no renewal required. Here some documents are required, like which includes the PAN card, proof of address and the bank details. Here we can say use of custom clearance, opening letters of credit and also the availing export benefits. There are also some types of exemptions that is applied to the certain entities, and also certain entities can include like government departments or the foreign diplomats. It helps in tracking the trade activities and ensuring the eligibility for the trade operations. If they are exporting the software, they need to register with the Software Technology Parks of India. And this code is necessary for international trade, and export imports must mention it all the relevant documents and the forms. Fine. That is the basically IEC means, why we need IEC and why this is one of the important code. Okay, then export declaration forms. If we see in the section 7 subsection 1 of the FEMA, according to the FEMA, all the exports from India, whether they are goods, whether they are services, they must be declared in the specific forms. These forms are basically of two types, that is EDF form and one is soft text form. EDF is export declaration form, and why this document is required? Because this is a document required by the RBI for clearing the foreign exchange earnings in relation to the export transactions. So we can say these forms confirm that the full value of the exports will be received within a set time and in a correct way. And what are the main forms? EDF and the softfix form. So you can see EDF form used for all the exports except the software regardless of the method of shipping. Where softtext form is specially, we can say, for the exporting software in a non-physical form. So this softex form is used to export of software and IT enabled services from the India. Okay, and why this is required? This is required for by the DGFT for the export of software and the services, which helps in tracking the foreign exchange earnings in this sector. Clear? Okay. Um, then let's talk about ACU. Let's talk about the ACU. What is the meaning of ACU? See, if I talked about the ACU, this is basically Asian Union Clearing Union, established in 1974, and this is a multilateral payment system. Multilateral payment system that aimed at facilitating trade among the Asian countries by clearing the payments through a central mechanism. And this ACU sets in 1974, and we can say here this facilitates the payment among its member countries. And what the payments and receipts can be made: ACU US dollar, ACU euros, ACU JPY, which are used for clearing the transaction between the ACU member countries. And these are the countries are included in this. And also we can say here some of the transactions that can be settled in these currencies. And for trade, for basically trade in the Myanmar, transactions can be settled in any freely convertible currency in addition to the ACU mechanism. While Nepal is a part of ACU, payments to Nepal are not settled through the ACU mechanism. So what is the motive of this ACU? To promote the regional trade, and it includes the countries like Bangladesh, Myanmar, Pakistan, Sri Lanka. It reduces the foreign exchange dependency. It lowers the transaction cost. It promotes the regional economic cooperation. And if we talk about the headquarter of this, the headquarter is in Tehran, and Tehran is in Iran. Clear with the concept of ACU? Then DDA. What is the meaning of diamond dollar account? See, if we talk about the DDA, it is a special type of account, special type of foreign currency account. And that special type of foreign currency account allows the Indian diamond exporters and the traders, so they can carry out the transactions in the foreign currencies. And primarily this is the US dollar. This is typically offered by the Indian banks, so they can facilitate the international trade of diamond goods, which ensures smooth financial operations. So whatever the exporters and importers who are dealing with the diamonds or the diamond studded jewelry, they can open the DDA with an authorized dealer. If a track record of at least 2 years is there, annual average export turnover of at least 3 crore is there, an exporter can maintain up to 5 DDAs. Okay, so understood the meaning of DDA here. Next is here EEFC account. EEFC account, you will study about a full chapter on this. EEFC account, exchange earning foreign currency account. What is this? This is a foreign currency account that can be opened by any individual. Any individual can open this account, or any businesses in India can open this account who earn the foreign currency, such as exporters or businesses in the special economic zones. That persons are valid for opening this type of account. Export finance means This is a type of financial support system which is provided by the RBI. Why RBI provided the support to the importers and exporters so they can runs the business smoothly. RBI introduced this system when in 1967. Why? To help the Indian exporters so they can get the money they need to compete with exporters from the other countries and boost the exports from India. And the idea is to give exporters access to loans at the low interest rate so they can perform better in the global market. That is why export finance is here. Then post-shipment finance. What is the meaning of post-shipment finance? If we talk about the post-shipment finance, this is a type of financial assistance. Again, this is a type of financial assistance that is provided by the exporters after the shipment of goods. It helps them in managing cash flow until payment is received from the overseas buyer. And here are types of the post shipment finance, like export bills purchased, discounted, negotiated, advance against bills sent on collection, advances against exports on the consignment basis, advances against the undrawn balances, advance against the duty drawback. This system helps in exporters to manage their cash flows and meet their financial needs at the various stages of the export process. Fine. Then we will talk about the PCL. PCL is pre-shipment finance, which is also known as packing loan, credit loan. What is the meaning of PCL? Export packing credit. This is a working loan which is provided to the exporters, and it helps in covering all the cost of producing, all the cost of preparing goods for the export. Lots of expenses it includes, like procurement of raw material, processing, manufacturing, packing, local transportation, and the labor charges. And to get this loan, the exporter must have a export order or an export letter of credit. The loan must be paid back using the money received from the export sales. In some cases, bank may allow the loan even if the order or LC is not provided immediately. Fine. That is the concept of PCL. Now, what are the special cases that has allowed packing credit advances? Packing credit can be given to all the suppliers under the rupee credit scheme, and this is when the main exporter has inland letter of credit, and this supplier can get the packing credit based on this LC. And if we talk about the post-shipment finance here, what is the meaning of post-shipment finance? Basically, this is a type of financial assistance that is also provided to the exporters after the shipment of goods, and so they can manage their cash flow until payment is received from the overseas buyer. The exporter here also need the IEC. Every shipment is accompanied by the declaration in the EDF and soft text form. An exporter have to submit the all documents to the authorized dealer within 21 days of shipment or software transmission. Okay. If there is delay in the submission, then they can provide the genuine reason. So then the extension period, the period is extended. And if the finance is in Indian rupees, then the bank will buy discount or negotiate the export bills at the appropriate buying rate. Okay, that is type of a bargaining. And whatever the interest loan is there, that is a guideline that should follow the guidelines of the RBI. Payment for the export should be received in that manner which is approved by the RBI. So every rule should be followed, every guideline should be followed. Basically, then exporter can receive the financial support after shipping the goods, that the process follows legal and regulatory requirements. And when an export bill is drawn in foreign currency, purchase, there is a question also there on this. Purchased, discounted or negotiated, it becomes part of the bank's forward foreign currency position. This means exporter is responsible for ensuring that the foreign currency is received by bank by the bill's due date. If the exporter does not receive the foreign currency by the due date, then the exporter foreign currency liability continues. And this liability remains until the bill is paid or until it is converted into the Indian rupees. Fine. And there is how export credit in the foreign currency. Exporters get credit at the competitive interest rate. Banks in India are allowed to provide the export credit in the foreign currency that is linked to the LIBOR. Fine. This is here we have to cover important things only. So we are going to cover about the EDPMS. Important thing. Export Data Processing and Monitoring System. What is this? This is an online platform. This is an online platform which is used by the Indian banks. Why? To track and to monitor the export payments. Okay. And it enables the RBI and banks to ensure that foreign exchange receipts from the exports are repatriated to India and reported properly. So first one, data reporting by the banks. Each bank will have to gather all the data from its branches and send it to periodically to help with proper monitoring and reconciliation. Caution list, bank will check all the list and refer to an updated list of exporters who are being watched by the RBI. Then RBI will add or remove the exporters from the list. If an exporter is not reachable or is not making efforts to receive payments for their exports, their name may be added to the list. There is advance payment for the exporters. Time extensions and write-off is also there for the exporters, and no separate reporting for the XOS is here. Banks no longer need to send separate reports for export bills that are overdue. This information is now captured directly in the EDPMS. This EDPMS is designed to make the process of tracking and reporting export data smoother for both exporters and the banks. Fine. Then factoring means factoring is a type of agreement between a financial institution and a business, and in this arrangement what exporter have to sell their invoices. This factor collects the money from the customer end and in return provides the exporter with the immediate cash. This is the basically meaning of factoring. What are the advantages of factoring? Immediate financing is there available up to 75 to 80%. No need for LC, saving cost for the importer. Credit check on importer and buyer is there. Sales ledger maintenance is there. Credit protection on all the approved debtor limits. Advisory services for the new areas, countries. And forfeiting, factoring and forfeiting, two important things we can say in this chapter. What is the meaning of forfeiting? See, this is a method of financing the export sales by discounting the export receivable without the exporter having to worry about there is a default in payment. Means if exporters sells the payment they expect to receive from the buyer to a financer at a discounted price, financer then takes on the risk of non-payment, not the exporter. That is the concept of forfeiting here. IDPMS, Indian Data Processing and Monitoring System. So basically this is a system which is used by the banks, in India. Why? To monitor and to track the domestic payments. Okay. to monitor and track the domestic payments. Why it is designed? It is designed to help the RBI, and banks now can track the payments under the export and import trade to ensure the compliance with the regulations and the reporting requirements. RBI created a working group to develop a system that would make it easier to process and monitor the import transactions. Okay, and this group is led by Shri A.K. Pandey, which included the representative from the customs, the DGFT, special economic zones, FEDAI, selected authorized dealer banks. They recommended the creation of import data processing and monitoring system, which would similarly to the export data processing monitoring system already in the place. Then there is a concept of the supplier credit. Basically, overseas supplier directly gives credit to the importer, meaning the importer can receive the goods and pay for them later. And in the international trade, payment terms are usually either sight, means immediate payment. This is a type of LC2. And credit means payment after some time. The credit period depends on the several factors. Whatever the supplier need is here for boost the sales, the demand for the goods in the market, and the importer requirements. And then what is the meaning of buyer credit? When the importer arranges credit from a bank or the financial institution outside their own country to pay for imported goods. In this case, the supplier does not need to worry about the payment because bank ensures that the payment will be made. Sometimes what happens, the supplier may not offer the credit, buyer may not be able to pay immediately. In that type of cases, the importer approaches their bank and asks for the help. And bank will use their own resources by doing the partnership with the foreign bank and arranges the payment to the exporters on the agreed price. And once all the documents are submitted, bank pays the exporter. Then the importer repays the bank and agreed due date. That is the concept of buyer credit. So basically we can say there is a lots of facilities are available for the exporters as well as for the importers. For both, so they can run their business, they can do buying and selling, run their business, especially at the international level, at the global level. They can do all the things without the we can say that they are not in the problem regarding payments and regarding the delivery of goods. Everything should be according to the guidelines, and these guidelines are made by different authorities. RBI, FEDAI is here, FEMA guidelines are here. So, too many portals are here to help the exporters and the importers. Fine. And lots of things are included here. Okay, so these are the things we studied today. We learned today some important topics in this chapter, facilities for the importers and exporters. So we can say that there is no numerical in this, but yeah, conceptual chapter concepts are included in this chapter. I hope that everything is clear to you, and if you like this session, you can give the like and subscribe to the channel, because lots of videos are will be there in the future. And then we will cover tomorrow chapter 6, and we will see all the important concepts related to the chapter 6, and the timing is same, 9:30 p.m. Monday to Saturday. And also, if you feel anywhere any type of doubt, you can do the comment. I will address the query, whatever you asked about any concept or any question you are having, then you can ask. So thank you so much for attending this session. If you like this session, kindly give the like and subscribe to the channel, and we will meet tomorrow for our next session. Till then, take care everyone. Thank you so much. Thank you.